More than half of the global financial system today depends on one assumption, that interest rates will eventually come down. Remove that assumption, and everything looks different. In the past, crises came from excess in one place, housing in 2008, tech stocks in 2000, but 2026 is not about one excess. It is about a system that only works if nothing goes wrong. Debt was built on low rates. Asset prices were justified by cheap money. Governments borrowed as if refinancing was guaranteed. Consumers spent as if credit would always be available. Now, the condition that made all of this possible is gone. This is not about a sudden crash. This is about fragility. And fragile systems do not bend. They break. 2008 was a shock. One sector failed, and the damage spread outward. Housing collapsed. Banks froze. Credit disappeared. But the rest of the system was still flexible. Interest rates could be cut. Government balance sheets were still intact. Consumers still had room to borrow. There was leverage, but it was concentrated. 2026 is different. Leverage is everywhere. Corporations depend on refinancing, not repayment. Governments roll debt instead of reducing it. Asset prices assume cheap money forever. Consumers rely on credit just to maintain their standard of living. In 2008, one engine stalled. In 2026, every engine is running hot at the same time. This is the critical distinction. Back then, failure was localized. Today, stress is synchronized. When housing cracked in 2008, the stock market was expensive but not extreme. Government debt was manageable. Interest payments were small. Policymakers had room to move. Now, there is no clean balance sheet left. The stock market is priced for perfection. Government debt is at historic extremes. Interest costs are compounding. Consumers are already stretched. There is no healthy sector waiting to absorb the shock. This is not about predicting which asset breaks first. That misses the point. In a highly leveraged system, the trigger does not matter. Only the structure does. And this structure does not tolerate surprises. When leverage is concentrated, it can be isolated. When leverage is everywhere, it becomes systemic. 2026 is not facing a crisis. It is facing a loss of tolerance. The system does not need a catastrophe. It only needs pressure. And pressure is already here. Most experts say 2026 will be fine. No recession. Moderate growth. A soft landing? You have heard this before. They said it in 2000. They said it in 2007. They said it every time right before the turn. This is not because they are careless. It is because their models are blind by design. Economic models assume problems arrive one at a time. They assume shocks are isolated. They assume stress can be absorbed gradually. Reality does not work that way. When multiple systems weaken together, correlations go to one. Diversification stops working. Backstops fail simultaneously. Models cannot capture that. They are calibrated to the past, not to structural change. They smooth volatility. They average outcomes. They remove extremes. Crises live in the extremes. In 2007, the data looked strong. Employment was high. GDP was growing. Credit spreads were tight. The models said contained. What they could not see was how housing, banking, derivatives, and confidence were already linked. They measured risk in pieces. The system broke as a whole. The same mistake is happening now. Experts look at stocks and say earnings are resilient. They look at consumers and say spending is holding up. They look at banks and say capital ratios are strong. They do not look at how all of it depends on refinancing. They do not model what happens when liquidity tightens everywhere at once. They do not account for feedback loops, and that is the fatal flaw. This is not fear-mongering. This is mathematics. When leverage is layered, failure is nonlinear. Small changes in rates, small declines in prices, small increases in defaults. Together, they become large. The experts are not lying. They are extrapolating, and extrapolation works until it does not. This is where the system first loses balance, not because assets collapse overnight, but because debt has to be rolled. Refinancing is the quiet assumption behind modern finance. Loans are not paid off. They are replaced. That works when rates fall or stay low. It fails when rates double. In the years after 2020, trillions of dollars were borrowed at 3%. Short maturities, floating rates, optimistic cash flow projections. Now those loans are coming due. Commercial real estate is the most visible example, but it is not the only one. Corporate debt, private credit, leveraged loans all face the same math. A loan refinanced at 6 or 7% does not just cost more. It changes the entire equation. Debt service jumps, Cash flow does not. Asset values fall because higher rates compress prices. That creates a trap. The borrower owes more, the asset is worth less. The payment is higher. There is no negotiation with arithmetic. Lenders cannot extend forever without recognizing losses. Borrowers cannot refinance without destroying cash flow. Buyers disappear because financing no longer works. This is how defaults begin, not from panic, from impossibility. In past cycles, refinancing stress was isolated. One sector failed, others absorbed the shock. In 2026, refinancing risk is synchronized. Too much debt was issued at the same time. Too many maturities are stacked together. Too many balance sheets depend on rates coming down. When refinancing fails in one corner, banks tighten everywhere. Credit standards rise. Liquidity retreats. That is the transmission mechanism. This is not a prediction. It is a process. When refinancing stops working, defaults are not optional. They are inevitable, and this is only the first point of failure. Once refinancing stress appears, asset prices lose their anchor. This is where illusion turns into exposure. Asset prices today are not built on cash flow. They are built on assumptions. Assumptions about rates coming down, assumptions about liquidity always being available, assumptions that someone else will pay a higher price tomorrow. That works in a stable system. It fails in a leveraged one. Stocks are priced for flawless execution. Bonds are priced for falling inflation. Private assets are priced using stale discount rates. Real estate is priced using yesterday's financing costs. There is no margin of safety. When rates rise, prices do not adjust smoothly. They gap. A 1% increase in discount rates does not reduce prices by 1%. It compresses multiples. It destroys narratives. This is why valuation extremes matter. Not because they predict timing, but because they remove buffers. When prices are reasonable, bad news can be absorbed. When prices assume perfection, bad news becomes catastrophic. In a highly valued system, volatility is not noise. It is information. As soon as credit tightens, buyers step back. Deal volume collapses. Price discovery disappears. This is how liquidity vanishes. Markets do not crash because sellers panic. They crash because buyers disappear. Everyone wants yesterday's price. No one wants today's risk. And when asset prices fall, leverage rises automatically. Loan-to-value ratios jump. Covenants are breached. Margin calls follow. This is where paper losses become real. It does not require a recession. It only requires repricing. And repricing spreads faster than fundamentals because once confidence cracks, correlations rise. Assets that were supposed to diversify move together. Everything becomes rate sensitive. This is not mispricing being corrected. This is structure being exposed, and without a safety net, there is nothing to slow the fall. In past crises, governments were the stabilizer. They cut rates. They spent aggressively. They absorbed private sector losses. That role depended on one thing, a strong balance sheet. That condition no longer exists. Today, the government is the largest borrower in the system, not a backstop. A participant. Debt is no longer countercyclical. It is structural. Each year requires more borrowing just to stand still. Interest expense compounds automatically. Refinancing is mandatory, not optional. This changes the entire dynamic. When governments borrow heavily, they compete with the private sector for capital. Rates stay higher. Credit tightens. This is called crowding out, and it is already happening. Fiscal policy loses flexibility. Every dollar spent on interest is a dollar not spent on growth. Defense or stability, monetary policy is trapped as well. Cut rates too fast, and inflation resurges. Hold rates too high, and defaults accelerate. There is no painless choice. In earlier cycles, central banks could flood the system with liquidity. Balance sheets were small. Credibility was high. Now, balance sheets are bloated. Inflation is embedded. Trust is fragile. Printing money is no longer neutral. It carries consequences. This is the most dangerous shift from 2008. Back then, the government could absorb shocks. Today, it amplifies them. When investors begin to question sovereign stability, everything reprices. Bonds lose their role as safe assets. Currencies become volatile. Risk premiums rise everywhere. This does not happen overnight. It happens gradually. Then suddenly, the firefighter is still on the scene, but the water pressure is gone, and when the backstop weakens, the entire structure becomes unstable. The consumer is the last shock absorber in the system. When corporations struggle, consumers keep spending. When governments tighten, consumers borrow. When asset prices fall, consumers delay, but do not stop. Until they do, what breaks the consumer is not one bill. It is the absence of flexibility. Credit fills the gap first. Then savings disappear. Then payments are skipped. This always follows the same order. Discretionary spending slows. Credit cards fill the difference. Auto loans stretch further. Buy now, pay later becomes permanent. This is not growth. It is survival. The key signal is not unemployment. It is delinquency behavior. Auto loans matter because they are functional debt. You pay the car before anything else. You need it to work, to earn, to function. When car payments are missed, every other option is gone. This is why rising auto delinquencies matter more than headlines. They show exhaustion, not stress. Once the consumer reaches this point, spending does not rebound quickly. It contracts quietly. Households stop upgrading, stop traveling, stop absorbing price increases. Revenue weakens, margins compress, layoffs follow. This is how consumer weakness feeds back into corporate earnings. And unlike past cycles, there is no buffer. Savings built during the pandemic are depleted. Interest rates punish new borrowing. Wages lag inflation. The consumer is no longer elastic. They are brittle. They do not break loudly. They simply withdraw. And when the consumer withdraws, the entire economy slows. This is the final link in the chain. Once it snaps, the system stops self-stabilizing. Individually, none of these failures are fatal. Refinancing stress can be managed. Asset repricing can be absorbed. Government debt can be rolled. Consumers can cut back. The danger begins when they interact. This is where systems fail. Commercial refinancing breaks first. Losses hit bank balance sheets. Banks tighten lending, not just to real estate, but everywhere. Credit contraction follows. Businesses lose access to working capital. Expansion plans are shelved. Hiring slows, then stops. Earnings decline. As earnings fall, asset prices reprice again. Stocks drop. Collateral values fall. Leverage rises automatically. This feeds back into banks. Tighter credit pushes more borrowers into distress. Defaults increase. Loss provisions rise. Capital ratios shrink. Banks tighten further. At the same time, consumers feel the impact. Layoffs increase. Hours are cut. Spending slows. Lower spending reduces revenues. Lower revenues force more layoffs. The loop accelerates. There is no pause button. In parallel, falling asset prices reverse the wealth effect. Households that felt secure stop spending defensively. Retirement accounts shrink. Confidence erodes. This is how sentiment becomes economic reality. None of this requires panic. It only requires adjustment. The most dangerous part is speed. Feedback loops do not move linearly. They compound. Small shocks propagate quickly when buffers are gone. Liquidity disappears before headlines react. Markets move faster than policy. This is what makes 2026 different. Not the size of any single problem, but the absence of isolation. When systems are tightly coupled, failure spreads faster than response. And once feedback loops dominate, control is lost. Every major financial crisis follows the same pattern. Excess, euphoria, exhaustion, collapse, reset. The assets change. The stories change. The structure does not. In 2008, the warning signs appeared years before the collapse. Rising delinquencies, tightening credit, experts saying, contained. Most people ignored them. Not because the data was hidden, but because believing it was inconvenient. 2026 looks familiar. Refinancing pressure is building. Asset prices are stretched. Government debt is compounding. Consumers are losing flexibility. These are not predictions. They are conditions. Nobody knows the exact moment the system breaks. Timing is uncertain. Direction is not. Fragile systems fail without warning. They do not give you time to react. That is why preparation matters more than forecasts. Liquidity creates options. Low leverage creates survival. Diversification creates resilience. This is not pessimism. It is discipline. The data is public. The warning signs are flashing. History does not repeat, but it always rhymes. And right now, the rhyme sounds dangerously close to 2007,